Podcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Bobby Rains here again for our once every 3 weeks members only workshop. Let's get started. All right, we have our usual agenda here. What's going on in Investors Observer, market update, member-driven content, questions, site demonstrations, etc. Anything else? Yeah, anything that you guys want to talk about, that is what we're here for today. So I got a couple of questions ahead of time. Thank you to those of you who sent those in. As always, you can just reply to the invite you get and say, "Hey, here's my question." That's probably the easiest way to do it. But yeah, any email you send us, just mention the webinar, and I can do that. During the presentation today, you can stick a question in the box there, and I'll get to it. I'll either interrupt myself as I'm talking or, hold it till the end, depending on how relevant it seems. So I don't have a lot of announcements for what's going on in Investors Observer. We're working on a couple of things that we, hope to move out later in the year. Some big, some small. We'll let you know when those happen. Yeah. All right. Let's talk about the market. So this is 2 years of daily candles on the S&P 500. This was the pre-COVID high. This date here, this most recent high is June 8th. That will be relevant or more relevant in the next few slides. You can see we kind of peaked out there and then been kind of in this range defined mostly by the next 2 days of trading since then, in terms of being not much below the low there and not, I think we might have taken out this high briefly this morning, but hasn't really been above there, and it doesn't look like we're going to close there. That way forward. All right, so this is year to date daily candles. It's a little bit less crowded this way, and yeah, again, you can see got this high, and we took it out this morning, but I don't think we got back there by the close. And so we've just sort of been in this range between, here and here since June the 8th, which is over a month now. So we'll see. It does look like there's some optimism there. But June 8th is interesting for some other reasons. In that it was, right, so this is the Washington Post's coronavirus tracker. June 8th is this day right here, I believe. It's pretty much the lowest day of new coronavirus cases. Right, we all know what's happened since then. And so sort of what's interesting is since June 8th, technology is up 5.5%, financials are down, consumer discretionary is up barely, but Amazon is 25% of the consumer discretionary ETF, and it's up 19.7% in that period. So if you take Amazon out of consumer discretionary, that's down. Energy down 20%, industrials down, call that 6%, biotech up. So other things were starting to come up, other things had been starting to rise. That helped the market peak. And since June 8th, we've sort of been in this weird, where the sort of reopening trade has gone away, right? So if you think about the reopening trade versus the virus trade, the reopening trade is things getting back to normal, right? That's financials, right? People moving money around, paying their bills on time, things like that. Consumer discretionary, people going out to restaurants, other things that fall into consumer discretionary. Energy, the biggest part of energy is oil, and oil is mostly used for moving things and people around. If people aren't going out and moving themselves and their stuff around, you don't use less oil, energy goes down. And industrials, that's both your automakers and your airlines and a bunch of other stuff. But yeah, that's down. And then biotech, right, that's right. bets on, vaccines, things of that nature. So what's interesting is today we had an up day, and it was an up day because of some positive headlines about vaccines. And so what led the market higher today? Financials, energy, industrials, also biotech. But yeah, so that's the kind of thing we're looking at. People talk a lot of times in more normal markets about risk on versus risk off in terms of, people buying stocks as opposed to bonds, and also people buying, growth versus value. What we've been noticing here pretty much since this started is there's a definite sort of reopening trade versus the virus trade. Today, it looked like the reopen trade won, right? All those things that are bets on the economy getting back to normal sooner, financials, industrials, that stuff, that was up. The other stuff lagged a little bit. Amazon was down today, for example. So that's one thing we've been sort of keeping an eye on, and it's it works pretty well if you get a positive headline. Those reopening things start to go up, right? Those are the positive days we've seen recently for airlines, especially since the 8th of June. This sort of trade has really come in and been pretty consistent. All right. So what else is happening? There's a ton of uncertainty. The whole cycle has moved faster than traditional economic data. And the economic data, including earnings reports, by the way, is backward looking. The market tends to be forward looking though, which is why things like forward guidance, what people, CEOs say on conference calls, things like that are more, drive the market a little bit more than what your company did, 3 months ago. The other thing to remember is reopening and reclosing, it turns out, are a process, and there's a whole patchwork of rules across states and localities. And so we've seen things open and close at this point now, but it's real patchy across states and localities. And also the other thing we've seen, we talked about this a little bit last time, and the pattern, I didn't put it on slides, but the pattern has held, is that I think it was JP Morgan had data that showed that credit card spending, especially the card present category, which means somebody going somewhere and scanning, swiping, or tapping their card, was down even in places that were open. So there was much less correlation across open versus closed than you might have expected. The whole thing, we will see in a few minutes, the whole sort of, a lot of those things have rolled over a little bit. That's thing. And so the things we're thinking about sort of going forward are, it feels like the longer this goes on, more of some of these temporary measures might start to become a little bit permanent. I can't tell you how many articles I've seen this week about, is the 5-day, 40-hour work week dead? I certainly don't know the answer to that. I can see pros and cons to both sides of that. Obviously, that only applies to people with certain jobs. But then some other things like, the cubicle farm, which the modern version of that doesn't even have cubicle walls, right? It's a whole bunch of people sitting at some tables. You can reopen an office way before you can put a whole bunch of people at a table. And business travel is another thing, right? If people discover that Zoom or, whatever other video conference they're using is an acceptable or acceptable-ish alternative to going somewhere, you might see a lot less business travel. But that it applies to other things too, right? Restaurant carryout. Restaurants might decide, their kitchens can produce a lot more food than they can serve on tables. So if you have that extra capacity, maybe you keep a carryout business going. I know some of the big restaurant chains were already doing that to some degree. It'll be interesting to see how many restaurants keep doing carryout. And the meal delivery services also, I include that in carryout. How many restaurants keep doing that as things start to get back to normal. And yeah, virtual meetings I think are probably a thing we're all going to have to deal with now. That's yeah, that's probably just going to be a part of our lives. I don't think all meetings will be virtual in the future, but I think more of them than before. And the other thing we're keeping an eye on is there's sort of an economic cliff in 2 weeks. The end of those expanded unemployment benefits is, I think, about July the 25th. The PPP loans are starting to run out, people are saying. So Congress is going to have to vote to, put more money out into the economy, or else there's going to be sort of a cliff where people are just out of money. To get back to banks a little bit, Jamie Dimon of JP Morgan, who's maybe the most famous, certainly the most famous bank CEO, maybe one of the most famous CEOs anyway, definitely said this week that this has been a weird recession where things are going to get, we know things are going to get worse. And he specifically mentioned, the end of these benefits and things like that. So I don't know if they're expecting Congress to do nothing, but they're certainly expecting the economic downturn to outlast the support programs. And yeah, the three banks that reported Tuesday, JP Morgan, Citigroup, and Wells Fargo combined put aside 28 billion in loan loss reserves. And that's just saying, hey, we don't think we're going to collect the full amount of these loans. So a loan to a bank is an asset. They're basically just saying, hey, 28 billion of our assets are probably no good. I expect we're going to see other banks and lenders probably putting aside a lot of loan losses this quarter. And then we'll see if it'll be enough. Starting in 2007, those loan loss reserves just went up and up and up every quarter for a while. So that's not necessarily a one-time thing there. All right, into the data. So here is the JP Morgan's consumer spending tracker. It lags a little bit. So this is from July 11th, and this is just credit card spending. As of July 11th, it was down day over from the 10th, up 2% over the prior week. But the big thing is, down. Yeah, so I think what this is saying is it's down 10.7% from the year ago here, which is up from down 11.4 on the 10th. And yes, that's well above the low of down 40%, but you can see here it started to come back, and it's been noisy. We had some ups and downs along the way, but this is a definite flattening out here, which is, again, June 8th is back here somewhere, but the real rise in coronavirus cases started to come on a little bit later, and then people started to stay home. And if you dig into this report, which I didn't break out, you can see the split in card present and card not present getting a little stronger there. But this is all spending. This is not just the card present spending. And just for recollection, this is from our last workshop 3 weeks ago, right? That's a pretty steady uptrend. You can see it's really sort of, flattened out since then. All right, and we see similar things in the TSA data. So this is just passengers that go through TSA every day, and then the red line is a 7-day average. You can see the growth has sort of started to slow down here. It's gotten a little bumpier. There's a holiday on July the 4th also, which makes this a little noisy. If we go back, go to this chart where we've charted the growth rate, you can see, right, the daily change essentially was going up, right? There was more passengers, this is the rate of change in the 7-day average because the daily is super noisy. But you can see every 7 days, the number was just going up, and then it flattened out, and now we've got days where it's going back down. So again, it seems like the recovery has stalled a little bit there. And this was interesting. I came across this today. This is from the Association of American Railroads. You can see everything is down. So this is week over week in terms of car loads from 2019. So this is the change. Yeah, nothing is at levels where it was a week ago. Even stuff like, non-farm and non-food farm products, stuff that grows you'd expect would be getting harvested, but no, auto parts are doing the best, we'll call that, but still not super great. And then, yeah, this chart's interesting because we have this week and year to date. And so the way I think about this is this week better or worse than how things have been for the year? And in almost every case, the real difference is motor vehicles and parts. So it seems like the motor vehicles are, the auto industry is maybe coming back a little bit in terms of production, at least. I don't know how many cars they're selling, but they're at least moving cars and parts around at higher levels than they have, sort of on average for the rest of the year. Whereas, yeah, everything else seems to be worse now than it was on average for the rest of the year. So that's kind of interesting. All right, so that is the market update. Let's get to the questions. All right, so the first question we got was from Wes, and he wanted to know, he basically wanted to go over the investors keyhole emails. Shows how to execute the trade. Terminology changes depending on platform and email, and he doesn't want to make a mistake, which certainly reasonable. So I pulled out the Wesco trade. He was looking here. This is what the email looks like, at least if you have dark mode in your email program. But yeah, so we have essentially sort of what we call the news here. Why we picked the trade is up here. This was from our insider activity IK. And then, but the trade details are what's down here in this box, and these are also available on the website. So there's the setup for the trade and a little bit of information, and then the trade is this part here. Okay, look at the August 30-35 bull put spread for at least a 75-cent credit. So what that means is you're going to buy the August 30 put, sell the August 35 put for a net credit of 75 cents. So we don't put prices for the individual option legs here. And that's because what you should do with this trade, and really all the trades we have here, unless we give you some specific reason not to, is these should go on a combined order ticket. And the reason I'm not going to try to show you how to do it on a brokerage site is every brokerage site is different. So some of them use real kludgy names like combined order ticket or spread ticket. Some of them actually have some helpful sort of things where they have a different ticket for covered calls or credit spreads or things like that. And this is a vertical credit spread, if that helps, depending on where you're trading. But yeah, you want to enter both of these legs together, and you don't really care what the individual prices are. What you care about is this. You want to enter it as a limit order for its limit credit for 75 cents. And that means your order will get filled at 75 cents or better, which in the case of a credit is a higher credit. On the debit side, you can put in net debit orders, and those orders get filled at your limit price or better, which in the case of a debit is a lower price. And so what's happening here is this is just a bet that the stock stays above 35. So if the stock stays above 35, the options expire worthless and you keep your credit. There's a different set of circumstances as the stock falls below 35, ranging from less than the full profit to a loss. The amount you have at risk here is 425. The way to determine that is look at the difference in the strike prices, $5 in this case, and then subtract out the net credit of 75 cents. So you get an at risk of 425. So you're risking 425 to make 75. That's how you get that target return of 17.65. and 14.36% is how far away the stock was at the time, which is this 4087. All right, and that is that. All right, the next question is from Kenny. He said the main question he has, especially since he loves option trading, is about margins. How and when are they charged, and how and when can they be paid off? So margin basically is just a loan from your broker. It's typically a short-term loan, which means typically has a pretty high interest rate. But depending on your broker and the size of your account, in a lot of cases, the interest rate will vary. Guess what? Like everything else, they charge more to people who have less money, which doesn't seem entirely fair, but that is how that works. So you can buy stocks on margin. You can't buy options on margin. I typed that wrong. So you can buy stocks, you can't buy options on margin. Where margin shows up in options is it's used to secure the liability in a position. So if you think back to the trade we were just looking at, you open the trade for a credit, but you have this potential loss of 425. That's a place where margin can be used. You can also do those trades cash secured. If you have the 425 per contract in your account, you just have to hold that in cash. That's totally fine as well, but margin also does show up there. It's charged essentially whenever you use margin to purchase stocks or create an option liability greater than the cash in your account. Right, so if you have $400 in buying power and you buy $700 worth of stock, well, 300 of that is on margin. And it's paid back essentially when the position closes. Right, so until you put cash back in to cover the loan, right, you're going to be charged that interest. And that's really all margin is. It's not. There's a lot of things that can happen, margin calls and things like that. Sometimes they don't charge you the full amount of what you're borrowing, or they will lend you less on certain stocks. Tesla recently, I think a lot of brokers increased their margin amount because Tesla got to be super volatile. And so what that means is you can't buy something 100% on margin. It's usually some percent of it has to be your cash, and then the broker will spot you the rest. But how much, what percent of any given position they're willing to spot you can change. And all a margin call is basically the broker saying, hey, we're going to change the percentage here, and you need to put more money in. So that's what that is. All right, so that was all the questions we got ahead of time. There's a couple here in the box, but anything else that anybody has a question about, I'm happy to go over. So the first question we have is from Thomas. He says, with the premium membership, can the stock screener output the earnings date? That's a good question, Thomas. It cannot currently, but that seems like something we could probably add at some point in the future. So yeah, I can't make any promises on that, but that's certainly something we can add in the future. All right, so Buddy says, where can I find tutorials on how to use the chart? So we don't really have a tutorial on the chart, but the Help Center has a lot of articles about just basic investing stuff, and then also, on the stock side, how the scores work, and on the option side, sort of what some of the trades are, how the strategies work, things like that. And then we have this profile and billing section here if you're curious about like, where are my emails, or how do I change my password, or something like that. How do I update my credit card? We've got a bit of information there about that. So yeah, I mean, if you have a specific thing you're trying to do with the chart, you can send that in either in the webinar or send it in some other time, and we can try to help you out with that. The charts are actually from a third party that lets us embed them in our website, so we don't have a ton of control over that. They change them on us occasionally, but it's a pretty nice chart, and it can do a lot of things. All right, so let's see. Mike says, can I show how to use the option screener? I certainly can. This is the option trade screener, and you can choose from any of these 7 strategies. We'll do covered calls for now. So you pick covered calls, and then, yeah, so they're, let's call that 2,600 covered calls today. So what happens is we have an algorithm that runs overnight and tries to find the optimum trade for every stock. And it takes into account our rating on the stock, which means that this overall score here, if we are more bullish on a stock, a lot of times the trade will be more aggressive, which means, the sold call is allowed to be further out of the money. It doesn't necessarily mean it will be further out of the money, but we're less concerned with downside protection on things that we feel good about going up. And so from there, you can go through and really select as many or as few of these things as you want. In terms of days expiration, you can put a maximum of, call it 6 weeks. Target profits, annualized return rates for covered calls. A lot of times if I'm doing portfolio trades, I'll do something like a 15. That's not too hard to get if you're looking at a 6-week trade. And then risk management, and yeah, there's other profit things under here, the actual dollar amount, dividend yield on the stock, stuff like that. Risk management, covered calls can get expensive. Buying 100 shares of stock, so you can cap it at, we'll say $50. And then, yeah, if you want, right, you're doing a covered call and you want things that are relatively bullish, you can say 65. We'll say 4 keys and above. Keys are our proprietary risk ranking system. And what that does is it considers the option trade without regard to our opinion on the stock. And so what it looks at for covered calls, it looks at things like, is it a long trade versus a short trade? Is there a lot of downside protection? And then also some more complicated stuff like how many strikes are there? Because if you have a covered call and you need to adjust it in some way, having strikes at every dollar or 50 cents gives you a lot more options in terms of adjusting the trade than, especially in a $50 stock with $5 strikes. That's just a lot harder to sort of manage that trade should you need to. So you can put in a key rating there. You can search for before or after earnings here. If I hit before earnings, it's going to take everything away because everything reports earnings in like the next 3 weeks. Yeah, and then, if you want to drill down and say, I only want to see stocks in real estate or whatever, you can do that. If you want to go down to the industry level, you can get there by just dropping down the, drill into the sector to hit the industries. And it works basically the same for all the option strategies. The basic things are like that. All right, so that's that. All right, linear regression. Let's see if we can find this. They've changed the controls since the last time I looked at it, but I think it's probably still here. So if you want indicators, it's this guy. You can change the, right, you can change from candles to lines or whatever these guys are called, I forget, area. You can change the intervals here, right? So if you look at candles, those will be 1-minute candles. That will be 1-hour candles. The actual time covered by the chart is this control at the bottom. And then, yeah, this little drop down here, you can change to all kinds of different ways of doing a chart. And then, yeah, hit this indicators, and I think it's just, yeah, linear regression. You can hit it like that, and that will put it on the chart. And then there is, this is the thing they have moved, is there used to be a little control where you could change the settings for the linear regression. Oh. I added another one. It's not super useful. Take a snapshot. Yeah, I'm not sure how exactly to adjust that now. I'll have to try to figure that out. But yeah, there's a ton of indicators under here. I mean, they've got your more traditional ones like linear regression down to, they still have moon phases. Yeah. If you're interested in moon phases up, well, they took that out of the free chart. But it's on tradingview.com if you want to view it there. All right. Yeah, so Lawrence, the My Portfolio tool right now does only show your stock positions. Options are accounted for in the like asset allocation chart and things like that. But we don't have, yeah, getting that data from, I forget how many different brokers we can pull that in from. But getting all that data and trying to line up the option symbols, because I was very surprised at the different notations and ways that that data comes through. So getting all that standardized so that we can, display things correctly is going to be a little bit of a bigger project, but we do have plans to do that eventually. So Prasanth says, with personalized option trades like vertical spreads, do you expect investors to wait till expiration, or will we send emails or updates on close? So personalized trades are these guys here. There's 9 different flavors, right? Conservative for calls and puts, diagonal spreads, vertical spreads, and then balanced and aggressive. So yeah, we're unable to send updates for those. The idea there is that you can manage them on your own. Vertical spreads, most of the time, we just hold to expiration. If you can get 90 or some percent of the profit and close it early, that's fine, but that gets to be a little bit harder with credit spreads than debit spreads for whatever reason. I think because both legs tend to be further out of the money by the time you can do that. But yeah, if you want something where we're going to send an update, the portfolios are there. We have started making portfolio trades again here in the last couple weeks. And yeah, we hopefully we'll keep that up as much as possible. All right, and then Vishnu says, I saw an IO article a few weeks back that said stock X is implying a Y% move prior to earnings. So that is, I believe, probably from our partners at MT Newswire, which is where a lot of this option stuff comes from. Let's see if I can find one of those. It does not appear that I can. But yeah, what that's basically doing is looking at the, if you look at the implied volatility, which you don't really even need the implied volatility. If you take the at the money call and the at the money put and add them together, add the prices together, that value as a percentage of the stock price is roughly what the option market is pricing in terms of a possible move in one direction or the other between whenever you're doing this, between now and expiration for the options you're looking at, basically. And so yeah, what a lot of people look at before earnings is basically look at the weekly options for things that are reporting earnings. We don't do a lot of that style of trading here. You know, it's certainly a thing that you can do and it works. I've talked to people who do it. But yeah, I mean, what you're going to want to look for in those cases is stocks where you think that either the premium is too rich. In the case of, you know, oh, well, the options market is pricing in a 10% move, but I doubt it's going to move more than 5. That's a real good way to, you know, a good time to sell options premium is if you think it's too high. Also, if you feel like you have a handle on the direction, right? So if the options market is pricing in a 10% move in either direction, you know, you can use one of our trades, you know, one of our strategies to make a bullish trade there if you think the stock is going to go up. And that's a good way to sort of capture that premium there. The other way to do that is to, yeah, I mean, you get into like straddles and strangles that way, either saying, oh, well, yeah, the options market has a 5% move priced in, but I think it's going to be 10, so I'm going to be sort of, you know, short that volatility, or I guess I'll be long that volatility, or, you know, the other way around. But generally, I think for most investors trying to trade based on what they perceive as options being mispriced is, it's very time consuming, and I don't think very many people make much money doing that. All right, let's see if I can recreate this. All right, so Jose, I just did what you laid out here and it shows me the one result. So I'm not sure, yeah, maybe try like a hard refresh of your browser or log out and come back in kind of a thing. That might help. I'm not sure. Okay, good. All right, so Mike says, which option strategy would I prefer in the current market? That's a good question. I mean, the portfolio trades we've put on in the last couple of weeks have been a diagonal spread and a vertical spread. And those were about the setup as much as the strategy. I mean, I don't know. Yeah, I don't know that. I guess there are some times where a strategy seems like it makes more sense than others. But I think most of the time it's really about the setup as much as it is the strategy. So I think probably, depending on what kind of investor you are, Mike, there's probably situations out there where any of the strategies could work. I mean, the thing that's kept us from opening more portfolio trades in the last 2 weeks is the fact that when you hit that options expire before expiration button in the screener, it makes everything go away because earnings season started Tuesday and it's just going to be real heavy until this time next month or so. And I don't, yeah, we try to avoid that source of extra volatility. So that's, yeah, I mean, that's what stopped us. I don't know that there's any real reason to think that any particular strategy wouldn't work. It really depends sort of on the setup. I mean, if anything, yeah, if the iron condors are maybe not something I would look at right now, just because betting a stock is going to stay in a tight range seems dangerous given what volatility has been. I mean, we've been, in a range for a while now on the major indices, but there have been some big swings in stocks over that time. So if you're trading individual stocks and betting they're going to stay in a tight range, that in particular makes me nervous right now. But I definitely think there are things that can win, bullish or bearish with any strategy. It really just depends on sort of what the setup you're looking for is. Okay. So Jeffrey, thank you, Jeffrey, says that if you go to the big chart, which you can get by hitting view larger chart, then you can change the linear regression. Oh, there it is. Okay. So once you get that to show up, you can go to this little gear and you can change how many days you want, or how many periods, I guess. That's a 2-hour chart, so we'll make this longer and make it days, and then make that like 200 days. So you can change it like that. So that's how you get that to work. All right, so the next question is, the short leg of the Chewy diagonal spread expires on Friday. Do we expect any adjustment before then? I'm going to keep an eye on the price. If it looks, yeah. I mean, if Chewy goes back up above 50, obviously we'll put out a closing order. Below 50, we might try to roll it. Right now, it's just not attractive to roll. I can just wait till next Monday and sell a new option and not have to buy this one back. So that's typically what I prefer to do, unless it gets to be priced at a point where the roll is just very attractive. But yeah, that's I wouldn't say I expect anything. It may or may not happen. But all things being equal, if Chewy is to stay at roughly the price it's at now, I don't see any real reason why I would adjust it between now and Friday. Yeah, I mean, yeah, just let it roll off, expire worthless. All right, so we have this other question here about tried and true methods for determining option pricing methods, whether for buying leverage or desirable covered call or naked put rights. I'm not 100% sure I understand all of that question, but in terms of, yeah, I'm be happy to talk about what I'm looking for in terms of. So a covered call and a naked put are functionally the same trade. And that's, yeah, a naked put is essentially selling a put. So a covered call is buying the call or buying the stock and selling a call against it. And selling a put is just selling the put. And the reason they are functionally the same trade is if your trade goes correctly, you walk away with some amount of money that is roughly equivalent to the option price. It can change a little bit on the covered call, but it's about the same. And if it goes poorly, you end up owning the stock at a discount to the price it was trading at when you opened the trade. So let's just keep using the spider here. So we go to option trades here. You can see, yeah, I mean, in this case, our covered call and our short put are, yeah, it's the exact same strike and expiration. The target profits and things are subtly different because of the, some differences in the way the options are priced, but that's pretty close. And so really what I look for in things like this is a stock, most of the time a stock that's in a steady uptrend. It's a lot of times the same thing I look for in a diagonal spread, or a bullish diagonal spread. Anyways, a stock that's in a steady uptrend, also a stock that's in a range. So something like, let me pull my slides back up here. This one. Yeah, so this is great, right? I'll happily make trades on stocks that are doing that all day. But this is also can be okay. What you want to do though is, right, especially after you've got this sort of second test of the bottom of the range, the stock's hit a point and then gone up and then gone down to that point again, and then is starting to go up again. If you can, if a stock is in a range like this and you can buy it near the bottom of the range, that's not really much worse than this. Maybe the stock goes down a little bit. I mean, all hell can break loose and the stock can break out of the range in either direction. That's the risk of trading. But, buying range-bound stocks, especially near the bottom of the range, or, for a bearish trade, I would maybe try to buy them closer to the top of the range. And so, yeah, I mean, that's, you want to give yourself a little bit of headroom there. I like to see confirmation for the bounce, so I maybe wouldn't do it this day, but that day probably looks better. That kind of a thing. Okay, so premium for my efforts, that's a different question. And the answer to that question has really changed in the last couple of years now that nobody charges trading commissions. I mean, when trading commissions were $10 a trade, selling an option for $25 didn't make a ton of sense because, right, I get 15 and the broker gets 10. That's no bueno. But if commissions are zero or whatever that charge is now, 65 cents or something, it really matters a lot less. Most of the stuff we do here will be, I think there's some that are around 75 or 80 in terms of like a covered call premium. The spreads are a little bit lower. What I look at most of the time, honestly, is annualized return. And so like for covered calls, that 15% annualized is about the minimum there. Every once in a while we'll break that if it's, we might collect a dividend or something that'll goose it a little bit, but I mean, 10% annualized is, I might as well just buy the S&P 500 most of the time, and not worry about the trouble trading. So that is, that's one reason. And yeah, I mean, I'll do less for like vertical spreads. $20 on a vertical spread doesn't seem bad if it's a $5 spread. And obviously that's usually about the floor there, but yeah, we can make that work. All right, so Norm says, is the capital needed for a covered call versus a naked put the same? So this is the difference, right? The covered call, you have to buy the stock. The naked put, you don't have to buy the stock. But this is where that margin comes in, right? If the stock goes to zero, guess what? You're on the hook for the difference between the strike price of that put and zero. So the capital needed is pretty similar. In a cash secured account, it's definitely the same. In margin accounts, they won't make you hold, for like the SPY trade we looked at, they won't make you hold the whole 370 whatever. Usually it's some percentage. But yeah, the at risk amount is basically the same. The capital requirements can be less, especially in a margin account. But that's the only real difference there. And yeah, I mean, the other difference there is, the covered call, you can collect dividends. Naked puts, since you're holding cash, if you're using margin, you're not going to collect any interest, but if you're holding cash, you can, in different times, collect interest. If anybody knows of a broker that's paying any significant interest rate on cash in a brokerage account, let me know, but it's hardly a thing at this point. All right, if there's more questions, I still got a few more minutes, but I'll go ahead and give my little wrap-up spiel here. This and all of our workshops is recorded. You'll get a link to watch the video and download the slides probably tomorrow morning. The next workshop looks like it's going to be about August the 5th. So be on the lookout for that. There'll be a link in that post tomorrow where you can sign up for that. And go ahead and sign up for it tomorrow, and then we'll send you a reminder email, or you can wait till we send the invitation. Either one of those is fine. As always, you can hit the help button on the website if you have any questions between now and the next workshop. Our phone number is also here on the website. We're answering the phone between 8 and 5 Eastern Time. Pretty much every day the market is open. So yeah, I don't see any more questions coming in. I think we got to everybody. If I didn't get to you, send me a note, through the help button or whatever, and we'll get you an answer by email. But yeah, thank you all for coming, and enjoy the rest of your day.